Hi, I'm Julian from Bigmore Associates. We are based here in Walton-on-Thames in lovely Surrey. Great to be part of a fantastic team here helping our clients with financial planning. Financial planning and investments can be quite complicated, and what I'm trying to do here today is just give you a little bit of insight into some of the strategies that are available to you as an investor that you should maybe be thinking about how you invest. The English language is notorious for having a word that can mean very different things. Unfortunately, it's no different with the financial services industry. We talk about two key approaches of investing. They call it active investing or passive investing. Now that may mean something to you, it may mean nothing to you, but hopefully by the end of this video, you'll have a better insight to what that actually is. Because it's important, because it can have a clear impact on the decisions you make as an investor to try and give you the best chance of achieving what you need to achieve for your financial goals in the future. Right, so let's move on to the first aspect, which is active investing. So in that context, what we mean there is you have an investment manager, a stockbroker, or maybe even yourself, looking to pick individual shares, stocks and shares in a given market with the idea, very simply, of beating the overall market average. A passive way of investing, as the name suggests to an extent, is instead of trying to do individual stock picking, you basically invest in a vehicle that just tracks the benchmark. The active approach is one that's been long hailed within the investment industry as the real good way of doing it, having someone working really hard for you. But over time, there has become increasing evidence that that is actually quite hard to do consistently over a long period of time. So whilst an active approach absolutely has got the ability to beat the market average, you've got to accept the downside. It can also underperform. One of the challenges with the active approach as well is that to do that, you're employing the skill of an experienced investor. That unfortunately doesn't come for free. So there is a cost involved with that, and they're often a lot higher cost than, for example, just buying a tracker fund that passively tracks the market. If your chosen investment manager, even if it's yourself, are fortunate at picking the right investments, the right individual stocks and shares, great, you've beaten the market. Problem is if you're paying someone a lot of money and they end up underperforming the market, it becomes a little bit more of a tricky conversation at the review. On the other hand, with the passive fund, you are never able to beat the market average because you're simply just buying the average. So that is a big drawback. However, at the same time, you've also then got the peace of mind of knowing you're not going to pick a fund that is going to dramatically underperform that market because you're just buying the market. Also, fortunately, with technology, we don't have to pay the computer as much as we do the investment manager. So from that perspective, it's significantly more cost effective to do. Charges matter. In fact, I'll go so far as to say that in our industry, the only thing that is actually guaranteed are the charges. There's a good reason why the regulator says past performance cannot be a source of guaranteed returns in the future. And there is a lot of truth in that. The challenge you have as an investor when you're looking to pick a new investment, no one's got a crystal ball, not even the skilled investment manager. We are all dealing with a future we don't know. So when you look to make that decision on where you want to invest your money and who you want to invest it with, all you've got is the past to go on. And that's the challenge. The past, unfortunately, doesn't mean a whole lot to you. It's when you invest, it's the next 5, 10, 15 years that matter. And that's something to bear in mind when you are looking to pick an investment. Whereas with a tracker fund, the track record is not actually an issue because you're not looking at the individual skill of a stockbroker or an investment manager. What you're doing is just buying the market. But some clients say, well, Julian, that's great, but I want my money to work for me. I don't just want something that's passive that just sits there doing nothing. Well, that's the problem you see with the English language. This concept of passive when it comes to a tracker fund isn't actually true. In fact, I will go so far as to say tracker funds are also active. Yep, you heard me right. They are also active. Well, how can that be? Well, let's take an example. Moving away to the other side of the pond in America, there's another big index called the S&P 500, basically the top 500 companies on the New York Stock Exchange. And basically with regard to that, if you go back 25, 30 years ago, the top holdings on that S&P 500, mostly banks and oil companies. That was pretty much it. Fast forward 25 years, and you now come up to other names which you may be very familiar with. In fact, I'm looking at one of the devices right now of one of those big companies called Apple, Google, Facebook, Netflix. None of those were those big holdings, but what's happened is as they've become more popular and as society has moved on, those companies have moved into that index and moved forward. So the point I'm making is you're not stuck in a set allocation within that tracker fund forever. The tracker fund is rebalanced on an ongoing basis, some on a quarterly. So for example, the fund that is currently, the company that's currently 499 drops to 500 and drops out. A company that's 501 drops back in. So it's not fair to say that if you're in a tracker passive fund, it just sits there doing nothing, because it does actually represent the underlying society of that specific economy over time. So that's something just to bear in mind. That does though cause another issue, because you might think, well, that's great, Julian. Which tracker fund do I buy? There are a lot out there. And actually that's where we do feel that expert investment management really can come into its own. Not with the individual stock picking at a high cost, but actually from a perspective where they look at the whole world and they look at different areas in the world that are doing different things at different times. China, Japan, Europe, the US, the UK, for example. In fact, there is significant academic research that it actually indicates that it's how you're allocated across those areas matter far more to generating your long-term returns than trying to pick individual stocks and shares in a given market. And that's where our view is, the way we look to invest our client money is by utilizing very experienced investment managers, but actually that they implement their skill in terms of asset allocation primarily through using tracker funds. So you do generally get the best of both worlds. You get an active approach in terms of managing across the world in a way that is in line with the level of risk you're comfortable with, but also at a significantly lower cost. We don't believe that that necessarily is the only way to invest, but we feel for the majority of our clients, that is a very effective way of not running the risk of investing in something that might underperform or not meet their expectations. But hopefully that helps today, just to give you some insight when picking an investment manager or picking funds yourself, to understand the difference between active stock picking, the pros and the cons, and also passive investing via the tracker route. Hopefully that's been helpful. Thank you for your time.